Welcome back, my friends. Well, my friends, the news today is that Qualcomm stock fell by 10% as phone chip sales dive. Qualcomm shares fell about 10% in Thursday morning trading after weak guidance, income, and revenue. The chipmaker is highly exposed to low and high-end phone sales because its chips show up in so many Android phones. Net income fell 52% year-over-year, handset chip sales declined 25% year-over-year. So what does this mean for smartphone sales? What does it mean for big tech companies? What does it mean for the economy? And, what does it mean for the future of the United States? But, before we get into all of that, please press the like button and leave us a comment below. We would love to hear from you. Please subscribe and hit the bell icon so that you are notified of upcoming videos when they are released. And, before we continue, a word from the sponsor of this video. Today's sponsor is InnerLife.com, creator of the InnerLife STS system. InnerLife STS is a cloud mobile platform for mental health care and its integration with primary medical care. InnerLife STS is designed for assessment, data collection and analytics, documentation, and progress tracking. InnerLife STS creates and composes conceptualized narratives and builds them into professional-grade reports. These reports are designed for use by mental health professionals, primary care physicians, justice system professionals and universities and include mental health assessment reports, mental health treatment reports, and treatment progress reports. And InnerLife STS uses doctor-selected pseudonames for all patients. So, only the healthcare professional knows the patient identity. Shares of Qualcomm fell about 10% in Thursday morning trading, a day after the chipmaker reported weaker than expected quarterly revenue and guidance as it continues to see declining sales for smartphone chips. Qualcomm's third quarter earnings beat on the top line, reporting adjusted earnings per share of $1.87 versus a Refinitiv consensus estimate of $1.81 per share. But that victory was overshadowed by weaker than expected revenue, at $8.44 billion adjusted versus an $8.5 billion analyst consensus estimate, and lower than anticipated guidance for the upcoming quarter. Qualcomm expects earnings of between $1.80 and $2 per share on sales ranging from $8.1 billion to $8.9 billion. Analysts had been hoping for $1.91 per share earnings and $8.7 billion in revenue, according to a Refinitiv survey of analysts. Net income also dropped 52% compared to the year-ago quarter, from $3.73 billion to $1.8 billion. Qualcomm is more exposed than most because of its heavy reliance on high-end and low-end Android phone sales. Handset chip sales declined 25% year-over-year, to $5.26 billion. Deutsche Bank analyst Ross Seymour minced no words in a Thursday note, downgrading Qualcomm to a hold and cutting his price target from $130 to $120. We believe confidence in the co's growth potential will remain challenged, he wrote in a letter to clients. Qualcomm stock fell on light guidance as it warns of further job cuts. Shares of smartphone chipmaker Qualcomm Incorporated were battered and bruised in extended trading today as the company warned that it's likely to miss Wall Street's earnings and revenue targets in the current quarter. Earlier, the company reported fiscal third quarter earnings before certain costs such as stock compensation of $1.87 per share, coming in ahead of analysts' consensus estimate of $1.81 per share. Revenue for the period fell 23% from a year ago, to $8.44 billion, just below Wall Street's target of $8.5 billion. Qualcomm also reported net income of just $1.8 billion for the quarter, down a staggering 52% from a year earlier. Qualcomm is badly exposed to a declining smartphone industry, because the vast majority of processors it makes are intended for premium and lower-end Android devices. Unfortunately for the chipmaker, most analysts forecast smartphone sales to decline this year amid the ongoing global economic slowdown. Qualcomm itself says it expects handset unit sales to drop by a high single-digit percentage this year. As a result, Qualcomm could only offer cautious guidance for the current quarter, saying it expects fiscal fourth quarter earnings of between $1.80 and $2 per share, with revenue likely to fall between $8.1 billion and $8.9 billion. That's short of Wall Street's targets of $1.91 per share in earnings and $8.7 billion in revenue. No wonder, then, Qualcomm stock fell more than 7% in the after-hours trading session, adding to a loss of 2% earlier in the day. Qualcomm said its CDMA Technologies business segment, which covers chips for smartphones, cars and other smart devices, saw revenue plunge 24% from a year earlier, to $7.17 billion. Within that segment, Handset chip sales generate the bulk of the revenue, but those declined 25% to just $5.26 billion, the company said. Qualcomm Chief Financial Officer Akash Palkhiwala said on a conference call that it's difficult to predict the timing of a sustained recovery and customers remain cautious with purchases. One positive for Qualcomm was automotive chip sales, which rose 13% from a year earlier. However, that remains a small segment of its business, pulling in just $434 million in revenue. Qualcomm's larger Internet of Things business, which makes low-cost chips for sensors, industrial devices and meta platforms incorporate its Quest VR headsets, delivered $1.48 billion in sales, down 24% from a year earlier. The Qualcomm technology licensing business, which generates royalties from customers wanting to access Qualcomm's patented technologies for cellular service, added $1.23 billion in revenue, down 19% from a year earlier. Hyundai IT Incorporated analyst Charles King said Qualcomm's situation can be simply summarized by the fact that when demand goes soft, life gets hard for suppliers. The company's substantial role in supplying the chips in smartphones, as well as in other mobile solutions, means that factors impacting consumers and businesses' buying decisions will cause ripples that rock Qualcomm's boat, he pointed out. The soft guidance for the upcoming quarter suggests that the company isn't trying to sugarcoat the challenges it faces. That display of honesty apparently isn't what many shareholders hope to hear. Looking for positives, Qualcomm Chief Executive Cristiano Amon highlighted the company's strategy around artificial intelligence. He told analysts on the call that Qualcomm's ability to run AI models on smartphones rather than cloud servers can result in many new applications and use cases, and potentially drive growth in future. The company recently showcased a number of cutting-edge generative AI workloads running at the edge, on smartphone devices, at the IEEE/CVF conference on computer vision and pattern recognition in June. In summary, we are uniquely positioned to help shape and capitalize on the upcoming on-device Gen AI opportunity, Amon said. It's an enticing opportunity, but for now it's one that Qualcomm has yet to capitalize on, and it showed today as it announced it will be undertaking further cost-cutting measures. The chipmaker has already slashed its cost base by 5% this year, relative to its spending in 2022, notably cutting 415 jobs at its San Diego campus. The additional cuts will largely consist of yet more layoffs, but the company didn't put a number on how many positions might be affected. Until we see sustained signs of improving fundamentals, our operating framework does not assume an immediate recovery, Palkhiwala said. Holger Muller of Constellation Research Incorporated said cost-cutting is the right move for Qualcomm, because its diversification into the automotive industry is not strong enough to make up for lost revenue elsewhere. The challenge for Qualcomm is it needs to strike the right balance in terms of cuts, Muller explained. This will be key for its performance over the next 3 to 5 years. Intel reported second quarter earnings on Thursday, showing a return to profitability after 2 straight quarters of losses and issuing a stronger than expected forecast. Intel CEO Pat Gelsinger said on a call with analysts the company still sees persistent weakness in all segments of its business through year-end, and that server chip sales won't recover until the fourth quarter. He also said that cloud companies were focusing more on securing graphics processors for artificial intelligence instead of Intel's central processors. David Zinsner, Intel's finance chief, said in a statement that part of the reason the report was stronger than expected was because of the progress the company has made towards slashing $3 billion in costs this year. Earlier this year, Intel slashed its dividend and announced plans to save $10 billion per year by 2025, including through layoffs. We have now exited 9 lines of business since CEO Pat Gelsinger rejoined the company, with a combined annual savings of more than $1.7 billion, said Zinsner. Intel's gross margin was nearly 40% on an adjusted basis, topping the company's previous forecast of 37.5%. Investors want to see gross margins expand even as Intel invests heavily in manufacturing capability. In the first quarter, Intel posted its largest loss ever as the PC and server markets slumped and demand declined for its central processors. Intel's results on Thursday beat the forecast that management gave for the second quarter at the time. Intel management has said the turnaround will take time and that the company is aiming to match TSMC's chip manufacturing prowess by 2026. That would enable it to bid to make the most advanced mobile processors for other companies, a strategy the company calls 5 nodes in 4 years. Intel said on Thursday that it remained on track to hit those goals. Earlier this year, Intel cut its quarterly dividend by more than 65%, from 36.5 cents to 12.5 cents. This cut came just weeks after the company implemented a wide-ranging set of cost cuts. And as we all know, inflation continues to rage in most of the world. Central banks are aggressively raising interest rates. Layoffs are sweeping the United States. So, consumers are pulling back on spending, especially discretionary spending. But, what do you think? Please leave us a comment below and hit the like button. We would love to hear from you. Please subscribe and hit the bell icon so that you are notified of upcoming videos when they are released. Please share this video on social media. Thank you for watching.